Intuitive Machines nearly squeezed a whole year of revenue into one quarter, and investors still got motion sickness because buying your way into space infrastructure is expensive. This is Earnings Unscripted. Today's May 14th, 2026, for posterity, and we're talking Intuitive Machines, ticker LUNR, Q1 2026.
Yeah. If you only read revenue, it looks heroic. $186.7 million, almost triple last year, and close to the $210 million that they did in all of fiscal 2025. But the bottom line says, congratulations, you bought complexity.
Exactly. EPS was negative 25 cents versus the negative 6 cents forecast. And the clean Q4 P&L wasn't really in the materials. So year over year is the fair comp here. Operating loss widened from $10.1 million to $39.2 million.
And cash got lighter. They ended with $231.6 million, down from $582.6 million at year-end, largely because Lanteris had a $403 million cash component. Not mysterious, but loud.
Tiny legal bit before we get too caffeinated. This is not financial advice, just our opinions, so please do not buy moon stocks because two voices in your earbuds sounded amused.
Please don't. The market had the same personality. Early reaction looked ugly with a sharp pre-market drawdown around the call. Then regular trading completely reversed, and the stock closed at $36.52, up about 2% from the prior close.
That is such a lunar move. Dramatic entry, dramatic recovery. Everyone checks whether the parachute opened.
Right, and I think the recovery makes sense if investors looked past EPS. Adjusted EBITDA was positive, $2.7 million, a record for them. And backlog jumped to about $1.1 billion. That is the oxygen tank. Some of it came with Lanteris, yes, but they also landed the Space Development Agency award and another NASA CLPS task order.
For listeners new to this one, Intuitive Machines is not just Moonlander Company anymore. They're trying to become the infrastructure layer between Earth orbit and the lunar surface, right?
That's the pitch. Landers, relay satellites, ground stations, navigation, national security payloads, maybe even orbital compute. Lanteris gives them manufacturing scale and defense work. Goonhilly, if that closes, gives them actual dishes on the ground. It is vertical integration, except vertical includes the moon, which is irritatingly impressive.
Irritatingly impressive is going on the merch. And there's this very human Goonhilly story. During the Odysseus landing, everyone is waiting to know if the lander survived. And the first heartbeat comes through this radar dish in the UK. Then they basically go, oh, okay, we should probably own that.
Exactly. Romantic until you put it in a cap table. Then it becomes strategy. The CEO's message is pretty clear. The next phase is not just who reaches space, it's who connects it, operates it, and bills for it at scale.
Okay, but this is where I get twitchy. The revenue mix looks more balanced now. Commercial, civil, national security, great. But they also said they're reporting as one segment, so we don't really get a clean heritage Intuitive Machines versus Lanteris view.
That's the annoyance. If management says integration costs are temporary, fine, we can test that. CFO Pete McGraw said SG&A should normalize materially as the one-time costs fade. But if the acquired business is blended immediately, investors have to infer a lot from gross profit, cash burn, and backlog conversion.
So first impression then, not a simple miss.
No, it's a scale quarter with a digestion problem. Revenue's real, backlog is real, the strategic map is more interesting than most small-cap space stories. But EPS, cash burn, and opacity are not footnotes. They are the price of becoming a prime contractor in public.
All right, that's the frame. Big moon infrastructure ambitions, very real acquisition hangover, and a market that panicked, then apparently had coffee. Let's get into the details.
The detail I keep coming back to is that there are two clocks running at once. One is the Lanteris cleanup clock, those integration costs that should fade. The other is the infrastructure clock, where spending probably does not fade because they're building the network they just promised everyone.
So wait, the market is asking, was this a one-quarter bruise? And you're saying maybe, but the company is also voluntarily walking into a much heavier business model.
Exactly. CFO Pete McGrath laid it out pretty bluntly. Gross profit increased to $30.1 million. SG&A was $50.7 million in the quarter, which includes $20 million of acquisition-related transaction and integration costs. The majority of these are non-recurring. Fine. If that's true, margins improve almost mechanically.
But the spending doesn't just vanish. It changes costume.
Yes. The transaction lawyers leave the room and the satellite engineers enter with a larger invoice. CapEx is already ramping for near-space network services. That's the real shift here. They're not just doing lunar deliveries anymore. They're trying to own the pipes.
The pipes being relay satellites, ground stations, rover connectivity, all the unglamorous stuff that makes space usable.
And billable. That's the key word. CEO Steve Altimus had the clean thesis line. The next phase of the space economy will not be defined only by who reaches new destinations. It will be defined by who can build the infrastructure, connect it reliably, and operate it at scale.
Which sounds visionary, but also, please value us as infrastructure, not like a contractor with moon boots.
That is basically the investor relations translation, yes. And to be fair, it is a better business if they can pull it off. A lander mission is episodic. A communications network, a lunar rover service, a ground station network, that starts to look more persistent.
The rover piece is sneaky interesting. NASA apparently moved away from this huge 10-year lunar terrain vehicle structure into smaller, one-year deployable missions. That feels like it actually favors Intuitive Machines.
It does, because smaller chunks reward speed. And Intuitive Machines is not pitching the rover as, here is a vehicle, goodbye. They're pitching autonomous driving, teleoperations, network connectivity, support for a lunar base. It's moon infrastructure as a service.
Please do not say moon SaaS.
Moon SaaS.
Yeah, I regret setting you up.
With radiation shielding, naturally. But the point is serious. If they win more of that surface infrastructure work, the revenue quality could change. Not overnight, but structurally.
Okay, but here's where I want to press. If the business is changing that much, and Lanteris is now blended in, how do we actually see whether this thesis is working?
We don't cleanly. Management said, and this was very direct, we report as a single segment. You won't see a distinction between Intuitive Machines and Lanteris. Operationally, maybe that makes sense. Analytically, it is annoying.
Annoying in the polite financial sense, meaning please stop hiding the ball.
More or less. It means investors have to reverse engineer the business from gross profit, cash flow, backlog conversion, and maybe commentary. You can't isolate legacy lunar margins from acquired defense manufacturing. So when management says costs normalize, we have to wait and test it.
And Lanteris didn't arrive as a perfectly clean spreadsheet either.
No, this is worth flagging without over-dramatizing it. The prior filing noted a DOJ civil investigative demand involving Lanteris and alleged false claims tied to cybersecurity requirements. Intuitive Machines has indemnification from the seller, so maybe the financial exposure is limited. But indemnification does not answer management distraction, compliance scrutiny, or reputational risk with government customers.
So the acquisition bought backlog, manufacturing scale, national security access, and also, congratulations, here is a box of federal contracting headaches.
That is the trade. And look, they did get something real. Altimus said Lanteris gives them the ability to produce multiple landers in 24-month cycles in parallel. That's not cosmetic. That's the difference between heroic project mode and actual industrial cadence.
I like that framing. Less one brave machine on the moon, more can you run a factory that happens to serve deep space?
Exactly. And then there's the weird optionality on orbital data centers.
Ah, yes. The space data center fever dream. Give me the 30-second version.
The 30-second version is terrestrial AI data centers are power constrained, and Intuitive Machines is saying, we know high-power spacecraft and thermal management. Altimus referenced power generation capability around 60,000 watts and talked about preparing for 100-kilowatt spacecraft to handle edge computing heat loads in space.
That's either wildly futuristic or the most expensive server closet ever imagined.
Both can be true. I would not underwrite the stock on orbital compute today, but As narrative optionality, it matters. It tells you they want to be seen as a space infrastructure platform, not a lunar delivery vendor.
So the deep dive answer is the ugly costs may fade, but the capital intensity is probably part of the new identity.
Yes, and the investor question becomes very simple, actually. Does backlog convert fast enough and clean enough to make that heavier model feel deliberate rather than dangerous?
Which is exactly where the outlook gets interesting, because now we have to ask whether management's guidance is confidence or just a very expensive promise.
I think it's both confidence and expensive promise. The charitable read is that they now have visibility most space companies would kill for. Management kept full-year revenue guidance at $900 million to $1 billion, and CFO Pete McGrath said a meaningful chunk of expected Q2 revenue is already supported by backlog.
So that's the calming tea version. Please stop staring at the EPS miss. We've got contracts.
More or less. And he also said they still expect positive adjusted EBITDA for the full year, with roughly 60 to 65% of backlog turning into revenue in 2026. That is not nothing. Backlog conversion is the bridge between story and actual business.
Yeah, but the bridge has tolls, cash burn, integration, CapEx, maybe Goonhilly closing in Q3, and then the whole question of whether they need more capital if the build-out runs hotter than expected.
Exactly. The next quarter is not about whether they can announce ambition. They can. They're excellent at ambition. It's whether SG&A actually starts normalizing, whether cash use cools, and whether revenue quality looks less acquisition flattered.
And then you've got the LTV awards expected by late May, right? The lunar rover contracts. That feels like the next emotional catalyst.
Yes, win that and the infrastructure story gets teeth. Miss it, and investors may start asking if they bought the factory before proving enough demand.
That's a sharp way to put it. I think my takeaway is Intuitive Machines is becoming far more real, but also less cute, less moonshot, more government contractor with rockets and invoices.
Which is probably how space infrastructure grows up, not with poetry, with procurement schedules.
Beautifully bleak. All right, we'll leave the financial story there. Big ambition, real backlog, still a lot to prove. Thanks for listening, everyone. If you want these earnings chats to just show up when the next company reports, following the show is the easiest little nudge. And quick transparency note, Earnings Unscripted is AI assisted with the figures grounded in company filings and the earnings call transcript rather than vibes. If you've got feedback or a ticker you want us to tackle, send it to earningsunscripted@datamadness.ca. Thanks for being here, and we'll see you next time.
Take care, everyone.